Hey everyone, really quick before the video begins, I spoke pretty fast throughout the video. I'm kind of tripping out because the video is 55 minutes long, even with talking fast. You're gonna want to take a lot of notes. If you have to slow it down and play it in like 0.75 playback speed, do as necessary. But um, I just wanted to throw that out there before you guys get into this. Thank you again for stopping by and watching the video. Now let's get into the video. What's up, traders? I'm Hotshot, and this video is going to be volume one in an ongoing series. Who knows when it will end, but this series is to train your eyes to see the optimal trade entry, what it looks like, and how it tends to form. I have spent hours watching ICT's OTE primer and his pattern recognition series videos to save you hours of your time as well. Um, I've actually gathered all my receipts. For any of you that wants to call me out and say I'm doing something wrong, believe me, there isn't going to be a thing you can tell me that will change anything said in this video, because everything has been said by ICT himself, and I'll provide you the video names in case you'd like to go find out the truth for yourself. This video is going to provide you a foundation. This video is going to be pretty long because I'm pretty much combining 21 ICT videos into one video here. And the videos that follow this one, I don't intend for them to be very long at all. I want to get to the point in those videos for you all. But this being volume one in the series, I want to remind the individuals that are new to ICT or to the hardline critics that can't stand ICT. The premise behind all this is not to say, here's what the market's going to do next. I'm going to show you how to go into your charts and annotate them like ICT and look for the optimal trade entry, because this is how he trained himself to see it back in the 1990s. We'll briefly go into bias, but we won't be talking about order blocks or fair value gaps, none of that. This series is going to, again, train your eyes to see a specific phenomena in the marketplace. And some of you are going to say, oh, this is something that everyone knows about. It's a Fibonacci retracement. ICT didn't invent it, and it's this and it's that. Okay, if that's your attitude, if that's how you think going into this video, I'm just going to waste your time. But for everyone else that wants to learn something, I want you to see what it's like over and over and over again. If anything is studied for a month, it really starts to take root in your memory and identification. The faculties that each of us have to see something that is important to us has to be activated. A common example ICT always uses is, if you buy a car and you've looked forward to buying this car, once you buy it and take it home, the very next day you're driving it, and it might be the day that you come home with it, you'll start to see that a lot of other people have that same car. And it's not that more people bought it because you did, but your reticular activating system has been keyed up to filter that car because it's meaningful to you. So by me showing you examples of this particular pattern and the signatures that generally repeat with it, you're going to see how you can start doing this on your own. And when you watch it live, you'll see many times its formation. Then you'll grow the confidence to demo trade it. And if you feel inclined to do so, I'm never going to tell you to put live funds at risk, because legally I can't do that. I'm not a licensed financial advisor. But if you feel the confidence to trade live funds, it's your choice. I will never tell you to do it. You may lose money. Everyone loses money. Even I lose money, and so does ICT. So that's your choice. You determine that. From here on out, I'm only going to be talking about the optimal trade entry. From experience and backtests, I truly do believe that this is the most simplest, consistent, accurate, and profitable, the most profitable concept from ICT over Silver Bullet, specifically because I don't trade futures no longer. I just want to focus on Forex. Over the 2022 model, Judas swings, anything you can think of, the optimal trade entry beats it. And you'll actually see why in this video and the many, many more to come after this one. I only want to talk about optimal trade entry. So Please don't reach out to me asking me to do this or that or talk about something else. I'm only going to be doing just this. This is my model that I've adopted. And again, this video is going to be a bit of a long one because I have to set the stage for what it is I'm doing so that way no one can say, you said it was going to be this and it's not. So if you're serious about understanding ICT's optimal trade entry, then prepare to take a lot of notes off this video because, like I said, this is all his 21 videos summarized into one. And if for whatever reason you can't finish this video in one sitting, pause it, notate the time you paused at, and come back at a later time, but you're going to want to finish this video. Okay, so in this pilot episode, we will be looking at GBP JPY, the British pound by the Japanese yen. I'm using tradingview.com as the resource and platform, and the data I'm pulling up, the GBP JPY, is by forex.com. So whenever you type in the symbol, like for example, up here, no, not right there. Not right there either. I need to press escape really quick, but right up here, like let's say you want to look up GBP JPY, I have it filtered so that way it's only forex.com. I only use forex.com, and so does ICT. So me and ICT always use forex.com. I'm gonna go ahead and full screen it again. Anyways, that way you can all see the price action the way that I'm actually going to be presenting it here. So when we look at the optimal trade entry and its formation on a day-by-day, daily basis, now I'm not here to convince you that you should be day trading every day. That's not what this is. Many of you are very new, and there's nothing wrong with that, but you cannot speed this process up. It has to be done methodically. It has to be done in a way where it just allows for development. You can't rush it. ICT says if you learn this, if you grow in comfort in identifying this over a period of time, minimum 4 weeks, daily study where you get very familiar with it and you gain a sample size of experience, you want to build on that. But before we get into annotations, for anyone who doesn't know what the OTE is, OTE or optimal trade entry is pretty much based on buying or selling retracements. So as the market makes an impulse move higher or lower, that impulse price move has to be incorporating a break in market structure. Then you want to buy or sell the retracement to capture the next leg higher or lower. An example of that is pretty much that's your break in market structure right here. And you want to catch the next leg right here. You want to buy here to capture it to go higher. Okay, just a little example of that. But now to delete that, huh? Vice versa, of course, if you're bearish. Anyways, we base our framework around Fibonacci, and Fibonacci is not magic. It's the target of liquidity. That is, the Fibonacci just helps us frame an underlying context. It just gives us a framework. Now, what makes a trade entry optimal is the fact that it will occur at a key time of day. It's a specific time window that begins at 8:30 and ends at 11 a.m. New York time. In this video, or not in this video, but in this window is when the pattern often forms. However, it can also form before 8:30. Specifically though, you want to take entry within this time window, the 8:30 to 11 New York local time window. ICT does say to focus on a rules-based approach and stick to it so we won't be confused when things go wrong. It'll simply just be a losing trade. You want to know what you're doing, what time of day you're doing it, what you're looking for, longs or shorts. And if it doesn't fit the criteria, you do not do anything and you just let it go. In this video right here, you're going to learn all those rules from all 21 of ICT's OTE videos that he provided for us on his YouTube channel. Throughout this video, I will provide what I like to call truths, facts, receipts about OTE that ICT said himself, beginning with this. In ICT's OTE Pattern Recognition Series Volume 1 video, ICT says, put the fact that this video and the videos to come are hindsight aside, like put it aside for a moment, because every single thing that you study when you buy a book, that's all hindsight too. So when you go to a seminar or a webinar, they show you previous examples, and that's all hindsight too. So just put aside the fact that this is hindsight for a moment, and just study this price action. So when we look at price action on the daily chart, we want to determine a daily bias. In other words, the next draw on liquidity. You want to try to get a read on where price is more likely to draw to next. Is it going to draw higher to an old high where liquidity resides, or lower to an old low where liquidity resides as well? And until it reaches that liquidity, you stay with that bias. Now, in ICT's OTE Pattern Recognition Series, Volume 14, ICT says that it's actually not important. Excuse me. He says that it's not important or required that price trades all the way to that liquidity area and higher. It just needs to draw towards it. The ideal scenario would be for it to run out that liquidity, but it's not required, especially if we're looking for day trades or intraday trades, which is the scope of the series. However, this allows us to go in each day and anticipate either an up close or down close candle in alignment with that bias. The main thing we're looking for is the reactions from the previous day's range. In other words, all you have to determine is if price is going to be running the previous day's high or previous day's low. This is your bias. However, in ICT's OTE Pattern Recognition Series, Volume 1, at 34 minutes and 3 seconds into that video, ICT says many times you really don't need a bias. But to determine a bias, ICT says in his OTE Pattern Recognition Series Volume 16 video that he's looking for those moments when the public or the retail trader, they see something in price action that is so loosely hinged on factual, real underpinnings in the market. ICT is waiting for moments where the public or retail trader's mindset or opinion about a marketplace is so obvious based on what's taught in books. ICT will look at opportunities and look for the opposing view to what a retail trader would see or expect in price action. So when there are relative equal highs or lows, or a real obvious support or resistance level where retail traders will very likely look to take entry at and put their stop losses below that support or above that resistance in that pool of liquidity. And they expect these levels to hold, but they expect these levels to hold because of what it did in the past. That is your next draw on liquidity. So you want to identify the most previous run on liquidity, an obvious swing high into buy side liquidity, or obviously an obvious swing low into sell side liquidity. Anytime daily runs out sell side or buy side liquidity, price is likely to either retrace back into that expansion range where we can see price expand again and target the newly created swing high liquidity, or swing low liquidity, or retrace back into that expansion range and target opposing liquidity for a potential reversal, or consolidate, then continue expanding or reverse. Now, how can we use that liquidity as a tool for bias? Well, right away, we're looking at a market that is predisposed to go either higher or lower to target that liquidity where the retail trader will sell or buy. So we'd be bullish or bearish. So the expectation is to see the previous day's high, if we're bullish, get blown out, vice versa. the previous day's low if we're bearish gets blown out. Now, excuse me, kind of running out of breath here, but we have now formulated a bias to target the next or current trading day. You want to annotate the previous day's high if you're bullish, vice versa, the previous day's low if you're bearish. This is important because this is a simple little facet, as ICT says, to go along with this OTE pattern. You'll begin to start seeing things that you didn't really see before, even if you're familiar with the optimal trade entry. Now, a good example of this is right here in GBP JPY. If we notice here, we actually have on the daily chart, we have some relative equal highs here. We have this high here from the past and this high here. This high ran out this one, but they're pretty relative, right? And you can see that price recently ran it out here, but it was like a shallow run. It's nothing crazy or anything. So it's likely that a lot of retail traders seen this as like a false break and they're selling around here and their stop losses are above in this area, are above the resistance levels, right? It's very likely that retail traders are thinking like that. And if we go to the 1 hour time frame really quick, you'll see here that price, or let me jump back up to the daily really quick. If you notice right here, you'll see that price on this day. So this is Tuesday. Okay, we're speaking specifically about Monday's trading day. Okay, it's Tuesday simply because it's not midnight yet, but the new trading day has already opened. But we're talking about Monday here. Okay, so if we're talking about Monday, we see that the previous day, which was Friday, open, and this was the low down here, and you can see that this was Monday right here, right? So we go drop down to the 1 hour. So this is Sunday's trading right here, and Sunday's trading, I'll give you a rule for this. You actually want to disregard Sunday's trading, this area from here to here. You only want to focus on Friday's high and Friday's low. So you can see that Friday, after Friday, Monday midnight opened. You can see this is 00. And if you guys don't have your time already set to New York, you can change it right down here on the TradingView time zone. The UTC doesn't matter, it's different for everyone, but New York, make sure it's set to New York, okay? Now you can see here at 00, which is midnight, New York local time, you can see that price came down and swept out Friday's low, right? It swept it out, took off, took out Friday's high right here, okay? Then it retraced back into the daily candles range for Monday. Okay, so right here, we have a market that is predisposed to go higher. So what are we going to be looking for? We're going to be looking for price to run out that previous day's high. It already ran it out. Now, I also have another rule that you're going to want to hear for regarding if price runs out that previous day's high or low, our next target, does it negate looking for the optimal trade entry in the New York session? And I'll cover this in a moment, but you can see here that we have a market whenever it was about the time for the optimal trade entry. We had a market that was trading somewhat down in here, which is like the middle of the current Monday's candles range. So, and we would be targeting the high here, right? The previous Friday's high, okay? So now we're gonna go down into the 5-minute time frame. Now that we understand that we are bullish and we are targeting Friday's high, okay? It's very important. This is a key facet to the optimal trade entry. Now, going down to the lower 5-minute time frame with our previous day's high annotated. If you're bearish, then you have your previous day's low annotated. In this case, we have them both annotated just for example purposes. But ICT says it's very important here to know your previous day's high or low. It's very easy to delineate it on the 5 minute as well. You just have to go to the previous day's midnight to midnight. So if we did the previous day's midnight to midnight, it would be right here, midnight. Range from this pink line to this pink line. The highest point, that's that day's high, and the lowest point is your previous day's low. Okay. Now, that's your previous day's range, and you just annotate the highest price in that range or the lowest. That's your previous day's range high or low above previous day's highs and below previous day's lows. There is a bank of orders that resides in the marketplace known as liquidity. When the market has a predisposed bias or trend or momentum, or you just think it's going to go higher, you want to focus on the previous day's high, and you want to see if it has the ability to stretch to reach up to that previous day's high. Vice versa, if you think it's going to go lower, you want to focus on the previous day's low, see if it has that ability to stretch to reach down to the previous day's low. Now, on 5 minute, in ICT's OTE Pattern Recognition Series Volume 1 video, at 26 minutes and 11 seconds into the video, ICT says, we're looking for a specific time and price. That's what makes the ICT OTE pattern what it is. It's not just going into the charts and catching every retracement, because that's just Fibonacci trading or ratio trading or harmonic trading. What makes this optimal is that it begins at a key time of day, a window that begins and a window that ends, and it's in the New York session. Pretty much real quick, I want to mention, if you haven't already liked the video, please like the video, and if you're not already subscribed, hopefully we can earn your subscription by the end of this video. But I really just wanted to throw that out there. If you're still watching, I really appreciate your support. Yeah, show some more support. I really do appreciate it. It took me quite a long time to put this video together, I'm not gonna lie. But anyways, never mind that. That key time of day when this pattern tends to form is 8:30 to 11 a.m. New York local time. And like I mentioned, if you haven't already, change your chart's time. You can do it right down here. Again, it's New York. The UTC doesn't matter. It's different for everyone, but just make sure it's set to New York. Okay. So now that you have your chart set to New York local time, you want to delineate your 8:30 to 11 New York local time. Okay. And that is going to be right in here. 8:30. So at 8:30, right here, price was on its way to the previous day's high, but it didn't run it quite yet. You can see that it did eventually run it, and of course, this is hindsight. Put away the fact that it's hindsight, put aside that for now. And I want to mention that in ICT's OTE Pattern Recognition Series, Volume 8, ICT says, if you're trading a Monday, delineate your Sunday trading 16:55 to midnight, which is Sunday's trading. So before 16:55, ICT delineates Friday's high, just like in this case here. We do it at 16. He says to do it at 16:55, so we'll do it for what he says. So 16:55 here, you want to go to that Friday's high, which we already delineated that. So just keep that in mind. Just a little note for your notebooks that ICT said himself. So if we're trading Monday, disregard Sunday and consider Friday. Friday's high or Friday's low. Now, this OTE 5-minute setup can set up before 8:30. Another thing for your notes. It can set up before 8:30, and when 8:30 opens, price can tap OTE and take off, or it can set up during the 8:30 to 11 window, or there can be multiple setups where it sets up before and during, or even just during multiple times. Something for your notes there. But what you want to see is on the 5 minute, if you're bullish, you want to see 5 minute price expand and take out an old 5 minute high towards the previous day's high. Here, you want to take a Fibonacci tool and attach the one level of the fib to the most current 3 candle swing low wick and drag the 0 level of the fib up to the most current 3 candle swing high wick, vice versa if you're bearish. You want to see 5 minute price expand and take out an old 5 minute low toward the previous day's low. Here you want to take a Fibonacci tool and attach the one level of the fib to the most current 3 candle swing high wick and drag the 0 level of the fib down to the most current 3 candle swing low wick. And yes, we attach them to the wicks as ICT did in every single video in his OT pattern recognition series. So I don't want to see anyone in the comments telling me I'm doing this wrong. It is correct. Now, right here, you can see that's exactly what happened. You can see here's a little high on the 5 minute. Price expanded, took it out. From here, we would look for our most recent 3 candle swing low. Now, what is a 3 candle swing low? Well, if you look here, we have this black candle here, this green candle here. Gosh, that's awful. Delete that. We have this green candle here. And we also have this green candle here. Notice how these 3 candles, this green candle, specifically this one, has the lowest wick, right? It has the lowest wick right here, okay? So because it has the lowest wick, it makes it a swing low. Same right here. See how this wick right here, I'm gonna circle it. See how this wick right here is higher than the one to the left and the one to the right of it? That makes it a swing high. Again, right here, see how this wick was lower than the one to the left of it and the one to the right of it? That made it a swing low. Again, this one right here, this wick right here, it's higher than the one to the left of it and the one to the right of it. This makes it a swing high. Again, right here, this wick right here, lower than the one to the right of it and to the left of it, makes it a swing low. Again, right here, this wick, higher than the one to the right, higher than the one to the left, makes this a swing high. This wick, higher than the one to the left, higher than the one to the right, makes it a swing high. This wick down here, lower than the one to the left, lower than the one to the right, makes it a swing low. I hope you get the point. Anyways, I want to show you the Fibonacci tool settings as well. Because again, this is based on the Fibonacci. Are my Fib tool settings. And these are ICT's Fib tool settings. You only need the ones that are checked. Okay. These are ICT's levels. All right. The levels on ICT's Fibonacci are 0, 0.62, 0.705, 0.791, negative 0.5, negative 1, negative 1.5, and negative 2 standard deviations. Optimal trade entry is the 62% retracement level of the fib to the 79% retracement level, and the midpoint or 705 level, that is your optimal trade entry. Now, the projections, aka our targets, are 0, 0 point, or 0, negative, yes, so 0, negative 0.5, which is this one right here, negative 1, negative 1.5, and negative 2 levels. From here on, I'm going to refer to ICT's OTE pattern recognition series in just volumes. So in volume 14, ICT says the fib is not the magic. It just allows us to frame a market that is really overbought without having to use any overbought or oversold indicator, because when price retraces into OTE, that's technically a short-term overbought market. When we're selling vice versa, so that's an overbought market when we're selling, and vice versa when we're buying, it's a short-term oversold market. And that's all the fibs help illustrate, and the projections are just a rough idea on how far the market could go. But again, we're linking that with the previous day's high or low. Now, there's more than a few ways on what 5-minute price may do in regards to previous day's high or low. From all of ICT's examples, 5-minute can blast through the previous day's high after determining daily bias is bullish. So our next draw on liquidity was that previous day's high, and price can use that previous day's high after blasting through it as support. And if we attached our fib, that support may align with the optimal trade entry. Or 5-minute can run past the previous day's high or low, then retrace way back into the current day's candle range, then take out a 5-minute high or low to create an optimal trade entry to target that previous day's high or low again. Or, and I hope you're taking notes of this because these are very important. Or it can also have not ran it at all, and 5-minute price just takes out an old 5-minute high or low toward the previous day's high or low, and that we can anticipate a retracement to enter on and target that previous day's high or low. So in this situation, price hasn't even reached that point when 8:30 to 11 comes. And that's our situation here. From 8:30, price hasn't even touched our previous day's high. It touched our previous day's low, but we're bullish, according to the daily bias. We are bullish, so we're anticipating price to run out the previous day's high. So that's our situation here. But it can also do a shallow run on the previous day's high or low during London, then run way back the other direction, taking out opposite liquidity, then turn around when 8:30 comes, and it can set up an OTE to target the shallow run and previous day's high or low, aka our daily bias. But in this situation, in volume 9, ICT says that if price trades to and through the previous day's high or low, when that previous day's high or low was our target, and this happened before New York session, even if it was a shallow run, where price just wicked it, that it doesn't negate looking for a setup in the New York session, 8:30 to 11. So you want to stick with where the liquidity is going to be reaching relative to the previous day's high or low. And if it's not really clear, just simply stay out. That way you can live to fight another day or just trade another pair. Anyways, once you have your Fibonacci annotated on your charts, which I am going to do so now. So once it took out this high here, this is where you want to anchor your fib. You're going to anchor it to the most current swing low level here, to the most current swing high level here. Cool. Okay. Now, again, I'm going to draw a line here, delineate our 8:30 to 11. Now, these are some very specific rules, so really get ready to take notes here if you haven't yet. In volume 1, ICT says he enters at the 60% level to provide him assurance that he will be triggered into his position regardless of spread. However, in volume 9, ICT says, keeping to the rules of this model, enter at 0.62% retracement level. In ICT's OTE primer, Intro to Optimal Trade Entry video, ICT says the stop loss will go at the 1 fib level. Specifically though, stop loss will go to the next nearest institutional level above or below the 1 fib level. And an institutional level, if you don't know what that is, it's pretty much just the 0 levels. If you see price over here, it is the 0 levels, 20 levels, 50 levels, and 80 levels. These levels are important because a lot of large fund traders make their orders very easy for processing and put them at those levels. So with that being said, since this is our expansion where we would attach our fib, swing high to swing low, right here you can see right at 8:30, price taps in, wicks into that 0.75 level. And again, ICT says to set your entry right here at the 0.62. The stop loss will go to the nearest institutional level right here, below the 1. So the next institutional level would be 50. See, that is the 150. Again, they're the 0, 0, 20s, 50s, 80s levels, okay? Now, in volume 5, first scaling, in other words, where you take partial profits, in volume 5, ICT demonstrates to take first partial scaling at 0 level of the fib. As soon as we take first partials, we will move our stop loss to 0.5% fib level, which will be half the range of our fib. Then we would target the nearest institutional level to the negative 0.5 fib level before running it for second partial profit scaling. Okay, so again, right here, you can see that price tapped here. It was about a 1-to-1 R. We would claim 50% of our position, and then we would move our stop loss from where it's at into profit right here at the 0.5. Boom. Okay. Now, for second partial profit scaling, we would target the nearest institutional level to the negative 0.5 fib level before running it for second partial profit scaling. And you can see right here, negative 0.5. If we look for the nearest institutional level here, it would be 50, which would be right here. So as soon as price taps right there, we would claim another 50% of our position, okay? So usually whenever price hits like our nearest institutional level to that negative 0.5, if price for whatever reason created like it went up like this and then created a swing low like this and then it targeted that 0.5 level and whatnot, once we take our partials here, we would then move our stop loss from the 0.5 here, and we would put it usually under the second. We wouldn't put it under the most current support or resistance, and yes, we would be pretty much putting our stop loss, joining the liquidity. So we would move our stop loss more into profit under or over a support or resistance level. And again, we'd be part of the liquidity, but we don't want to be under or over the nearest support or resistance level to current price. We want to put stop loss under or over the second nearest support or resistance level of price. So a better example would be right like this. I gotta just do it in full screen. I'm very sorry, you guys. I'm not used to that, or half the screen, not full screen. I'm not used to doing full screen all the time. I'm very sorry, you guys. Anyways, let's say that price is something like this, right? Went up, came down, went up, came down, and then took out our area where we would take next partials. Our stop loss would go from the 0.5 right below this one right here. The second, not the most recent current one, but the second support level here. And again, we'd be joining the liquidity, but we're not the most current. Because if price wanted to come down, take out this liquidity here, and then continue up, we wouldn't get taken out. We'd still be a part of the move. Okay, make sense? Now, since it hasn't done that, we're just going to leave our stop loss at the 0.5. We've taken more partials. And next, And we will next target the nearest institutional level to the -1 fib level before running it out, aka -1 standard deviation. And this will be for our third partial profit scaling. And if there was another swing low that was created, then we'd move our stop again. You want to continue to trail your stop loss with the second most current swing low, resistance or support. Um, resistance if you're selling, support if you're buying. But the next institutional level here, since this came in at 68, below that would be the 50. So it would be right here. Once price tapped that, we target another partials. We take out more partials here. And then at that point, we ran out that previous day's high. That previous day's high was our target. And you can see that price ended up turning all the way back around, stopped us out in profit. So this was a winning position. Now, if price didn't stop us out, then we will target the nearest institutional level to the -1.5 fib. It came in at 66, so we would drag it down to 50. Boom. And again, continue to trail your stop loss as necessary. And once this got hit, lastly, we will target either 100 pips if it hits before the nearest institutional level to -2 standard deviations, where we will collapse the trade fully. But if 100 pips is after -2 standard deviations, then we will just target the nearest institutional level to the -2 fib level and collapse the trade fully and be content here. So like in this case, right here, it wasn't 100 pips. It was only about 50 here. So we would target the next institutional level here, which would be the 50 level, which would be like right here, where that is at. And that would be where you would collapse the full trade. Now, in volume 10, ICT says your big figure targets are rounded down below the fib levels if you're buying, like we demonstrated here. And if you're selling, they're rounded up above the fib levels. So just vice versa, what we demonstrated here. Because again, we're just using the Fibonacci as a framework. It's just a rough idea in terms of the basic profile to the trade. We don't demand that these fib levels get hit. It just helps us structure the trade and where we can put our entries in, what our stops are going to be, and then project it up for potential targets. But we use the liquidity above the previous day's high as the real framework. In volume 14, ICT says, some of you may really like to look at risk to reward ratios and says, this is what has to happen for me to take a trade. You can make an amazing career trading one-to-one if you have a very solid strike rate. And clearly, as ICT indicates in these examples, this pattern works every single day. In volume 15, ICT says, what's more important, your target, your risk to reward target being hit or profiting? Because so many traders in this industry lose money and they've had open paper profit and not just demo trading. Like, how many times have you traded with live funds and watched potential profit just turn on you and turn into a loss? How many times would you go back in time, hypothetically, and say, if I just would have took something off when it was giving me X amount of pips or X amount of dollars before return, and you did that as a general rule of thumb, you always pay yourself. If you worked a partial week at your job, so you work a normal Monday through Friday, and you worked Monday and Tuesday and got sick, so you were out the rest of the week. Does your employer get to keep all those earned income hours that you put in on Monday and Tuesday? Of course not. So when the market offers you an opportunity to take something off and scaling, you have to do that. Otherwise, you fall victim to something like the example where both patterns, like the example in ICT's volume 15 video, where both patterns offered an opportunity to book profit. Hypothetically, But if you don't execute those partials that are at logical levels that we talked about in the fib, you're not forced to take something off, but this is what will happen invariably if you keep doing this long enough. You're gonna have a trade that will look good. It'll look real good. It'll look strong, like it's performing, and it may in fact look like it's gonna go and run above that high. But it peters out and loses momentum and goes the other direction. So you're either left with being upset and emotional about not taking partials and getting stopped out, or learning from that and saying, okay, I can take something off and I'm not going to demand my best case scenario exit for target, and I'm going to take something off. There is a large amount of traders that will say partials is stupid. Partials is just a rookie attempt to just satisfy the fear and greed tug of war what's going on. And ICT agrees with the last part. It rewards your time and risk, and it doesn't matter that you're reducing the amount of potential profit. You're reducing the same thing on a relative basis that you had in terms of risk. You're reducing it as you take something off. You're paying the trader, you're rewarding your initial risk and taking something out. ICT guarantees if you try this, you will love this because it manages all that fear and greed, that tug of war that takes place once you put that trade on in a live setting. You want to get out of the trade, you want it to get to your target right away, but you can't force that. But as it logically moves to these levels where you could take partial profits and exit some of the position, thus reducing the exposure or risk, but rewarding and adding to your bottom line because these previous days highs or low targets are not guaranteed. But if you're in a market and it's trading near the zero fib level, like it did here, and you put your market order to get out, that's more likely to fill you in a profit than waiting for that undelivered target. A couple of random notes for you to jot down. For those of you taking notes, in volume 13, ICT says it's okay if price trades a little past 79% retracement level. That's fine. Okay, that's no problem at all. As long as it holds and it doesn't stop you out, that's still a good trade. In volume 4, ICT says if price taps the OTE level at exactly 11 and that previous day's high or low target hasn't been reached yet, that this is a valid entry, even if it's the second OTE setup in the session, 8:30 to 11. If if a candle taps that 11, same situation like how we did right here, 8:30 to 11. This candle right here specifically, 8:30 tapped right here. That's an optimal trade entry. And you can see it was very profitable here. In volume 8, ICT demonstrates how price may run out the zero fib level, but not the negative 0.5 level. He says you don't need it to. Fibs are just a ballpark figure, and the markets don't move on the fibs. The Fibonacci just helps us frame an idea that is very visual to a new trader. So you don't need it, but it helps give the foundation to a new trader who can't really see key price swings in a trend or a fractal of price action. Now, that's all the truths, facts, and receipts I've gathered from ICT's 21 videos, and I hope you took a lot of notes on all that. These are some little notes that I would like to throw in for y'all as a bonus that I've witnessed that ICT didn't mention, but his examples actually demonstrated. Regarding what 3 candle swing low and 3 candle swing high you attach your fibs on, if you're bullish, you attach the one level of the fib on the most recent 3 candle swing low and drag the zero fib level up to the most recent 3 candle swing high after 5 minutes takes out a previous high. If price makes a new 3 candle swing high, then drag the zero fib level up to that one and leave the one level of the fib alone. If price takes out the one level of the fib, we will consider this a turtle soup, which is one of ICT's concepts where price will sweep liquidity, then turn the true direction. In this case, we will leave our zero level of the fib alone, but drag the one level fib down to the next 3 candle swing low wick we come to, and we will look to take entry off the OTE there. If this gets stopped out, we walk away. Now, if price happens to take out another 5-minute high and makes a new 3-candle swing high and a 3-candle swing low, we will disregard the one we have annotated and annotate this new one and prepare to take entry off this new one. Now, if you're bearish, you attach the one level of the fib on the most recent 3-candle swing high and drag the 0 fib level down to the most recent 3-candle swing low after 5 minute takes out a previous low. If price makes a new 3-candle swing low, then drag the 0 fib level down to that one and leave the one level of the fib alone. If price takes out the one level of the fib, we will again consider this a turtle soup, which is one of ICT's concepts where price will sweep liquidity, then turn the true direction. In this case, we will leave our 0 level of the fib alone, but drag the one level of fib up to the next 3-candle swing high wick we come to. That's logical and framed a nice OTE where price isn't too deep or past the OTE, and we will look to take entry off the OTE there. This gets stopped out, walk away. Now, this isn't in our OTE time of day to take the entry, but this is an example of that. You can see that price here took out these highs. Now let's say we drew our fib here. You can see that price took it out, right? Now if we drag down to here, you can see that came down, it was in here. If we got stopped out here and we drug it down to this one here, it's too deep and it's kind of past OTE, right? But if we drug it down to here, look at how accurate into the T it taps that 0.75 level, 705, which is the mid-level between OTE. Taps it beautifully and goes back up for that previous day's high again. Now, that's just an example of that. Again, it's not an optimal trade entry because it's not in our time of day. This is just an example of when you want to drag that point A, aka the one level of the fib if it gets stopped out. Okay, you just want to frame it where it's logical and where it's a nice OTE. Okay, now if price happens to take out another 5-minute low and makes a new 3-candle swing low and 3-candle swing high, we will disregard the one we have annotated and annotate this new one and prepare to take entry off this new one. Okay, so in step one, determine bias and if we will be targeting previous day's high or previous day's low. Step 2 is drop to 5-minute and wait for 8:30 to 11 New York local time and delineate it. Step 3, identify a potential OTE setup before 8:30 or during 8:30 time and draw your fibs. Once fibs are drawn, step 4, set your limit order at the nearest institutional level above 62% retracement level if we're buying and below it if we're selling. Stops will go always at the 1 fib level, specifically at the nearest institutional level below the 1 fib level if we're buying, above it if we're selling. Step 5, target 0 fib, specifically the institutional level before the 0 fib level gets hit. So below it if we are in buys and above it if we're in sells, just like we've demonstrated here on this specific setup. Okay. Where we will claim 50% partials, then we want to move our stop loss to this 50% fib level, specifically the nearest institutional level above 50% if we're in buys, below 50% if we're in sells. Then target the negative 0.5, specifically the nearest institutional level below negative 0.5 if we're in buys, and above negative 0.5 if we're in sells, where we will claim another 50% partials, then move stop loss to the second support or down to the second resistance level like we demonstrated earlier. Then you want to target the -1 standard deviation fib level, specifically the nearest institutional level below -1 if we're in buys, above -1 if we're in sells, where we will claim another 50% partials. Then if another swing has created, move stop loss again, trail your stops to the second support or down to the second resistance level. Then target the -1.5 Specifically, the nearest institutional level below negative 1.5 if we're in buys, above negative 1.5 if we're in sells, where we will claim another 50% partials. Then, if another swing has created, move stop loss, trail it again to the second support or down to the second resistance level. Then lastly, target 100 pips if it gets hit before the -2 standard deviation, specifically the nearest institutional level below -2 if we're in buys, above -2 if we're in sells, and if that level gets hit before 100 pips, then we will just target that level where we will claim the full position. Okay, so those are the specific rules. This is the approach and setup. I know this was a long video, but hopefully you found this insightful. If you made it to the end, you've got a bright future ahead of you. More OTE examples to come. Until next time, though, be safe and good luck in your trading.